Hello, everybody. This is Sunko, the Korean Bro. Today is 2022, November 15. Let's look at today's economic calendar, okay? Mm. We had a PPI from United States. Let's look at what PPI stands for. PPI is Producer Price Index. Okay, the producer price index measures the change in the price of goods sold by manufacturers. Change in the price of goods sold by manufacturers. It is a leading indicator of consumer price inflation, which accounts for the majority of overall inflation. It is a leading indicator of a consumer price inflation, which accounts for the majority of overall inflation. Once again, okay, higher than expected readings should be taken as positive bullish for the United States. And what do we have? November 15, 2022. Actual point is lower than forecasted. So while lower than expected reading should be taken as negative, bearish for the United States. Okay. The change in the price of goods sold by manufacturers is a leading indicator of consumer price inflation, which accounts for the majority of overall inflation. I don't know how this is going to affect stock market, but we'll see. Okay. Hmm. June 14, July 14, August 11, September 14. Every month we've had PPI, and it's been quite rough, I guess. Some day it was higher than forecasted. Some day it was lower than forecasted. Just 2 months ago it was about the same, and a month ago, actual point is higher than forecasted. Uh, and let's look at this article. I think we can get a hint with this article. Okay, U.S. producer price inflation fell to its lowest in over a year in October. Bolstering hopes that pipeline inflation pressures have peaked thanks to the improvement in global supply chains over recent months. Okay. U.S. producer price inflation fell to its lowest in over a year in October. Okay. Fell to its lowest in over a year in October. Bolstering hopes that pipeline inflation pressures have peaked thanks to improvement in global supply chains over recent months. Price rose by a modest 0.2% on the month and were up 8.0% from a year earlier, comfortably below the 8.3% that was consensus forecast. Okay. Hmm. Okay. So price rose by modest 0.2% on the month and were up 8.0% from a year earlier, comfortably below the 8.3% that was the consensus forecast. Okay. The Bureau of Labor Statistics also revised down its estimate of producer prices in September to show a rise of only 0.2% rather than the 0.4% initially reported. Okay. Core PPI, which strips out volatile food and energy components, was even more placid. Price ra- Prices stagnated on the month, bringing the annual rate down to 6.7%, its lowest since August last year. Massive disruptions to seaborne trade had caused worldwide shortage of components and other intermediate goods earlier in the year, leading automakers and others to restrict output and squeeze prices higher. Those bottlenecks have, by and large, worn in recent months, however. The figures show the conspicuous drop in profit margins across the economy as overall activity slowed. Margins received for final demand services in particular fell 0.5%, leading to the first monthly drop in prices for those services in 2 years. Hmm. Okay. What was expected was a 0.4% increase, but we had a 0.2% up. So what we can realize is that it bolsters hopes that pipe inflation pressures have peaked thanks to improvement in global supply chains over recent months. Okay. Hmm. It only rose by 0.2%. That's the point. Okay. And what else do we have? On November 16, we have a core retail sales, crude oil inventories. And on Thursday, we have a CPI from a Eurozone, building permit initial jobless claims. Mm. And so goes on and on. And what articles do you have in Mali for? Two top AI stocks ready for a bull run. One solid index fund that dividend investors can buy with confidence in the bear market. One impressive metric shows how well the ocean is doing. It's just a stock of buy. Just bought shares of Apple's key chip maker and seven other stocks. Okay. Mm, okay, let's start reading it. Okay. Hmm. Mm. Okay, first, two top AI stocks ready for a bull run. The market potential for AI is projected to grow by 20% a year through 2029. And now it's 2022, so 7 years more to come. Alphabet is using AI to help improve its Google search engine for customers. ANSYS is using AI to improve its engineering simulation software. Hmm. Alphabet is a leader in AI for the internet, but there are multiple companies working on AI for more physical applications like semiconductors, the space economy, and the automotive sector. Enter ANSYS is a global leader in simulation software for research and development departments. Okay. ANSYS had dozens of software products that cover a variety of end markets, but all with a common goal to simulate the real world in a multi-physics environment. Multi-physics is a broad term that means replicating a real-world physical properties like electricity, heat, or stress loads on a product, but in a simulation. Along with other engineering software companies, ANSYS helps companies like Tesla and Rocket Lab perform simulations for their manufactured products, all within a realistic software environment, saving time and money with their research budgets. Engineering simulations require vast computing power, which ANSYS is trying to improve through its AI and machine learning research. Engineering simulations require vast computing power. The company claims AI can help with the speed and accuracy of these simulations, which makes sense since machine learning is generally just one big data problem. These developments should not only help ANSYS improve its products for customers, but also distinguish it from any software challengers, insulating it from a competition. Okay. ANSYS. Okay, let's look at ANSYS. Full-time employees. The number of full-time employees working at this company are 5,500, and develops and market engineering simulation software and services worldwide. It offers NZ's Workbench, a framework upon which its multiphysics engineering simulation technologies are built, enables engineers to simulate the interactions between structures, heat transfer fluids, electronics, and optical elements in a unified engineering simulation environment. Okay. Anything else? Nope. Alphabet is also working on AI. Let's read this article, okay? Alphabet is the parent company of Google, YouTube, and the Google Cloud Platform. The technology giant is one of the premier AI companies worldwide, using it to help its search, mapping, and other functions. CEO Sundar Pichai highlighted Google's research multiple times on Alphabet's recent earnings call, saying that the company is using AI to bring significant improvements to search, and that he thinks AI is the next big revolution after mobile phones. Here are a few examples of how this can work in practice. With trillions upon trillions of pieces of information across Google Search, YouTube, and Google Maps, Alphabet is able to harness AI to greatly improve search results, no matter where customers store their inquiries. Hmm. Okay, this means that if, for example, you search Google for how to fix a particular device, It will bring up a YouTube tutorial that you can play to learn exactly what you need to do. As these AI models ingest more data, they will continue to improve search results, which will improve Google's customers' experience. Through Google Cloud, Alphabet's cloud infrastructure segment, the company is selling its AI capabilities to other businesses. Companies of all sizes, they want to use AI but don't have the internet research capabilities, can buy Google's machine learning products through the cloud. Um, that's a big reason Google Cloud revenue grew 38% year over year last quarter. With the stock down 34% this year, Alphabet has a market cap of $1.2 trillion over the last 12 months. It has generated $67 billion in net earnings, giving the stock a trailing price to earnings ratio of 17.9, which is below the market average. For a company with such an advantage in AI, a huge opportunity to grow its business this decade. Now it looks like a great time to pick up shares of Alphabet. Alphabet, let's see. Hmm. Its all-time high was 148, and Alphabet's main goal is to make AI machine to make search algorithm more powerful. So mm, by using AI algorithm, they want to make it useful. They want to make it mm, customer oriented product. Uh, they will make it based on user experience. So the more people use it, the more search engine can possibly be a perfect tool for search uh, purpose. So Alphabet should be taken into consideration. Okay. And next, we have one impressive metric shows how well DigitalOcean is doing is the stock of buy. DigitalOcean's organic revenue grew, accelerated to 33% in quarter third 2020. Cloud platform leaders Amazon and Microsoft both reported decelerating growth in comparable quarters. DigitalOcean, cloud platform leaders Amazon and Microsoft both reported decelerating growth in comparable quarters. Hmm. The cloud is big and only getting bigger, and DigitalOcean has a lot to gain in the coming years. Many expected DigitalOcean to disappoint in the second half of 2022. With global economic conditions worsening, the small cloud computing infrastructure service could easily have shrunk back. After all, it focuses on small businesses, which many investors view as getting hit hardest by a deteriorating economy. And DigitalOcean's high rate of international revenue was never going to help either. Not with the US dollar on a record run up. Mm. Instead, DigitalOcean surprised the naysayers during its quarter third 2022 report and showed it is more than keeping up with its cloud titan peers. In fact, this one metric shows just how well it's doing right now. What economic slowdown? DigitalOcean reported a total revenue growth of 37% in quarter third 2022, or 33% on an organic basis. Mm. What's impressive about the 33% rise is that it was an acceleration from a 29% in quarter second. That stands in contrast to the cloud titans Amazon Web Services and Microsoft Azure, both of which decelerated in the third quarter of the calendar year compared to earlier in the year. Hmm. Alphabet, Google, also far smaller than AWS and Azure, also notched a healthy acceleration in cloud infrastructure growth in quarter third. So, unlike Titan peers like Microsoft and Amazon, both of which decelerated in the third quarter, but what's impressive about the 33% rise is that it was an acceleration from a 29% in quarter second. Hmm. So increase is phenomenal compared to uh, the ones like Amazon and Microsoft. Of course, this is just one quarter of results. This the ocean could see weakness in its financials going forward, especially if the US dollar continues to take a heavy toll on revenue from outside US. But as of right now, digital oceans is looking incredibly resilient. The outlook for the final quarter of 2022 implies year-over-year revenue growth of 34% at the midpoint of guidance. Hardly a picture of a business struggling against uncertain economic conditions. So is this stock a buy? Okay. DigitalOcean CEO Yancey strongly noted on the earnings call that it's too soon to say when weakness in the global economy will ease. However, the fact business is holding up well in spite of various issues is notable. Hmm. As Sproul pointed out, many investors view small and medium-sized businesses as being particularly vulnerable to economic downturns. Thus far, DigitalOcean's revenue growth would prove otherwise. Mm. SMBs are nimble and in the face of uncertainty can quickly pivot. Moving operations to cloud is a way to save money, and clearly many SMBs are choosing DigitalOcean to cater to their digital needs. To capture expected demand in the coming years, DigitalOcean is working on new specific use cases for its platform. It's also expanding its geographic footprint. Mm. Like the recent opening a new data center in Australia, all the while DigitalOcean is still able to maintain robust profitability. Free cash flow was $22.4 million in quarter third, or just shy of a 15% profit margin. Hmm. I might have to look into this one. DigitalOcean. And Warren Buffett just bought shares of Apple key chip maker and seven other stocks. Hmm. Uh, what seven other stocks did he buy? Let's see. Berkshire Hathaway, biggest investment in the third quarter was in the world's biggest chip maker. Hmm. Buffett and his team also took a position in two other new stocks while adding to five existing holdings. The company completely exited one position while trimming its stake in five other existing holdings. TSMC. Okay. Berkshire Hathaway, the huge conglomerate run by legendary investor Warren Buffett, released its always anticipated 13F filing on Monday afternoon, detailing the company's portfolio moves from the third quarter of the year. We already knew from Berkshire's latest earnings report that it had purchased close to $9 billion in stock and sold $5.3 billion worth in the third quarter. But the 13F, which is required for large institutional investment managers, removes the mystery. A key part of Apple's business. Arguably the most notable move by Warren Buffett and Bush in the quarter was their investment in the world's largest chipmaker, Taiwan semiconductor manufacturing company, also known as TSMC. Bush purchased roughly 60 million shares in the company, amounting to $4.1 billion at the time of the purchase. They equates to roughly 1.2% stake in the company. Okay. TSMC is a powerhouse in its own right, but it's also a key supplier for Apple. Key supplier for Apple, okay. TSMC is like a key supplier for Apple, okay. The consumer tech giant was TSMC's largest customer in 2021 and made up a quarter of the company's revenue last year. This year, the number is expected to be even higher, even as TSMC anticipates more room to grow in other sectors such as the auto market. TSMC, okay. Apple is also Berkshire's largest stock holding by far. Making up roughly 40% of an equities portfolio worth well over $300 billion. It's quite common for Berkshire to find stocks through existing companies it operates or owns stock in. For example, the company credits its investment in cloud storage company Snowflake. The fact that its insurance brand in Geico have been one of Snowflake's clients for some time. We know Buffett and Berkshire really love Apple, so this investment makes perfect sense. Let's see. Patience can pay off handsomely when you're investing in game-changing businesses. For short-term traders, 2022 has been a nightmare. Okay. All three major US stock indexes have entered the bear market, but for long-term investors has been a blessing in disguise. A number of short-term headwinds have created a perfect storm to lower equity evaluations. For patient investors, it's a roll out the red carpet opportunity to put your money to work at highly advantaged prices. PayPal Holdings, Fever International, PayPal Holdings. Let's look at PayPal Holdings. PayPal Holdings. Mm, okay. PayPal Holdings. PayPal has lost close to 70% of its value since the summer of 2021, with concerns about high inflation impacting low earning consumers weighing on its shares. However, the skepticism surrounding PayPal tends to be short term in nature and overlooks an exceptionally long growth runway for digital payments. Although estimates for the global digital payment market vary widely, research in the market.com is forecasting red hot 20.5% compound annual growth rate for global digital payments through 2030. In my view, this figure could be even higher depending on how quickly the metaverse becomes its own ecosystem. PayPal could very easily hold the world's leading share for this sustainably fast growing industry. As I've mentioned before, what's been most impressive about PayPal has been its ability to grow in a challenging environment. Even as the likelihood of a recession has grown throughout the year, total payment volume on a constant currency basis has sustained a low double-digit growth rate. Furthermore, PayPal's active accounts are increasing their usage on its digital payment platforms. 2 years ago, as of September 30, active accounts were completing 40 transactions on a trailing 12-month basis. As of September 30, 2022, active accounts completed 50 transactions on a TTM basis. Engagement is everything when it comes to digital payments, and more transactions will lead to higher gross profit for PayPal. So people are more engaged as the years goes on. More transaction means more profit. So its revenue is growing. Hmm. PayPal Holdings. Fever International. Okay. Let's see. Another stock that can make you a millionaire by 2032 with an initial investment of 250,000 is online services marketplace Fever International. Fever International. Uh-huh. If there is a not against fever, it's the expectation that the labor market is going to worsen in the coming quarters. The central bank is purposely raising interest rates to tame inflation and shift wage power back to businesses. If the unemployment rate were to rise, it could dampen demand for freelance projects. If the unemployment rate were to rise, it could dampen demand for freelance projects. But once again, we're talking about a short-term issue and not anything that would meaningfully alter Fever's growth strategy or long-term sales trajectory. Over the next decade, a company tied to the success of the U.S. labor force will be expected to benefit from the expansion of U.S. gross domestic products. However, long-winded periods of economic expansion are just small reason to be excited about Fever's growth prospects. What should really excite current and prospective investors is the permanent shift we've witnessed in the labor market due to the COVID-19 pandemic. So, earlier, we look at PayPal. PayPal is a company that produces a digital payment system. And in the coming years, we all know that we'll be using digital payment more because it's a huge trend that nobody can go against. And Fever International, it's a freelance company, and we all in the past 3 years, what we realized was that labor trend has been changed. Labor trend has changed. Hmm. What here it is. What we witnessed in the labor market due to the COVID-19 pandemic, as well as Fever's industry-leading take rate. Hmm. Although some workers have begun returning to the office, a sizable percentage of people now work at least part-time from home. Data from the 2021 American Community Survey shows that 17.9% of people primarily work from home now, which is a 214% increase from the 2019. So more and more people work from home and they work remotely. And it's a trend that continues. Even COVID-19 is not as tough as it has been. Uh, it's not as tough it has been. Okay. Hmm. Gig economy companies like Fever that allow freelancers to showcase their skills and services that become increasingly important. So platform like Fever International has become more important because people gotta do marketing. They have to let world know that you have this skill, right? So it's a perfect platform for a freelancer. Fever's marketplace is also unique in the way freelancers present their services. Whereas most competing online service marketplace platforms have freelancers price their services on an hourly basis, freelancers on Fever price their tasks as a package deal. It's what we said before, right? This leads to improve the price transparency for buyer, uh, as well as a willingness to spend more on these services over time. Even with recessionary fears brewing, and spend per buyers climbed to 12% in September and ended quarter from last year. Maybe best of all, Fever's take rate crushes competition. Mm. Take rate describes how much of each deal negotiated on its platform it gets to keep. How much of each deal negotiated on its platform it gets to keep. Fever's take rate expanded to 30% on nose during the third quarter, which is nearly double its peers. So Fever, they're way above competition, like because their take rate is way too high, and take rate describes how much of each deal negotiated on its platform. Mm. And lastly, we have Fever and Pinterest. A third stat that can make you millionaire with a 2032 is social media stat Pinterest. As what people in favor of Pinterest has been hammered by the current bear market, skeptics have been particularly worried about Pinterest's declining monthly active user count and wonder how its driven operating model will fare if a recession materializes. Historically, advertising revenue is one of the first things to decline when economic growth weakens. But as you can probably surmise, these concerns are both short-term in nature. Uh, Short-term in nature, okay, and don't impact Pinterest in many catalysts. The first thing to note about Pinterest is that its MAUs are once again rising. MAUs are once again rising. So what does that stand for? Even though year-over-year MAUs were flat at 445 million when the September ending quarter came to close, this marked the second consecutive sequential quarter where MAUs increased. Huh, huh. Monthly active user. Okay. Interesting. Advertising revenue is one of the first things to decline when economic growth weakens. Okay, it's one of the first things to decline when economic growth weakens. Okay, these concerns are both short-term in nature and don't impact Pinterest's many catalysts. So monthly active user rises. Mm. Monthly active user increases. Mhm. And what else do we have? The company's user count has steadily climbed when examined with a wider lens. Okay. Despite a short-term MAU decline, as, as life returned to some semblance of normal in the wake of the pandemic, there isn't anything for long-term investors to worry about with regard to attracting and engaging users. Another important selling point is that Pinterest has never had any issues in monetizing its users, whether its MAU count has been rising over the long run, following the short term, or has been flat year over year. The company's average revenue per user keeps climbing. Okay, average revenue per user. Okay, especially in international markets. This demonstrates the value of a Pinterest platform and the willingness of merchants to pay a premium to get their message in front of its 445 million MAUs. So what we can notice from this article is that when economic condition worsens, the first thing to decline is revenue of a marketing company. But uh, for sure, MAU, monthly active user of this company, increases uh, when examined with a wider lenses, mm, and they have no problem monetizing its user. Okay, they haven't had any issues. They've never had any issues monetizing its users. Mhm. So people keep using a premium service when advertising their products. Okay, and let's read. Keep on reading it. But as I studied, Pinterest platform has the greatest advantage. While data tracking software changes have hurt other ad-driven platforms, the entire premise for Pinterest is to have users willingly share what interests them. This makes it really easy for advertisers to target specific users. If they choose, it also makes Pinterest a logical choice to become a significant e-commerce player at some point this decade. Willingly share what interests them. Willingly share what interests them. So they have a different system when it's compared to other companies. And next, what do we have? Cloudflare and Datadog. It's the same company over and over, right? Okay, let's read this. Cloudflare. Okay, economic uncertainty has caused the stock market to crash this year. Nasdaq Composite tumbled 36%. Okay. Anyway, we have two companies here. Okay. Mm. Cloudflare and Datadog currently trade at a big discount to their historical valuations, and it creates an attractive buying opportunity for patient investors. Cloudflare, a leader in content delivery and cloud developer tools. Cloudflare provides cloud services and developer tools. Its platform accelerates and protects corporate applications and infrastructure while eliminating the need to maintain complicated network hardware in private data centers. So Cloudflare, um, they don't let customers use a complicated hard network system. Mm. Cloudflare shares a direct connection with every major internet service provider and cloud provider, which positions its platform within 15 milliseconds of 95% of internet users worldwide. So without using complicated network system, they are able to let people use internet. Um, they're, they can they can make every internet service provider uh, get connected. Hmm. That network architecture gives the company an advantage. Cloudflare is the fastest cloud provider in North America, Australia, Japan, and the majority of South America and Europe, topping rivals like Amazon Web Services and Fastly. Not surprisingly, it ranks as the market leader in content delivery network software. Content delivery network software. According to G2 Grid, but Cloudflare has distinguished itself in other areas as well. Last year, Force Research recognized Cloudflare workers as the market leader among edge development platforms, citing speed and intuitive interface as key advantages. Speed, intuitive interfaces. Speed and intuitive interfaces, okay? This year, Cloudflare redoubled its leadership position with new storage services. It announced a D1 database for structured data in May, and it launched the R2 storage for unstructured data in September. Those products extend the utility of the Workers platform, enabling developers to build applications and websites without relying on external storage solutions. Hmm. Stores. So okay, let's summarize. They have um uh their service provider, and what they provide is they don't let customers use complicated network system, and they have what is it? New store services. Hmm. Okay. And lastly, financially, Cloudflare is growing very quickly. Hmm. Its customer count increased 18% to okay. Looking ahead, management put the addressable market at $135 billion by 2024, meaning Cloudflare has hardly tapped its massive potential. Better yet, management says annualized revenue will grow fivefold to $5 billion over the next 5 years. Data, the alert and observability software. So we all observe, right? We look at log when a system error pops up, and we observe a lot, right? So it's a observability software. Datadog provides monitoring and security software. Its platform analyzes signals produced by applications, networks, and infrastructure to help businesses keep their IT environments performing and secure. Okay. Datadog simplifies adoption with 600 pre-built integrations. And its artificial intelligence engine, Watchdog, accelerates workflows by predicting issues and automating root cause analysis. In June, research company Gartner recognized Datadog as a leader in application performance monitoring and observability for the second consecutive year. They're like the leader, okay. Application performance monitoring and observability for the second consecutive year, citing its Watchdog AI engine and its broad portfolio as key strength. Not surprisingly, the company also enjoys a strong market presence in other observability software verticals, including cloud infrastructure monitoring, network monitoring. Datadog recently issued a solid third quarter earnings revenue. Its customer count climbed to 28% and the average customer spend 30% more. But Datadog has plenty of room to run in the coming years. Has plenty of room to run in the coming years, okay? Okay. And recently, they introduced Cloud Coach Management, a product that helps businesses understand their cloud experiences by attributing span to specific application services. Okay, this is it for today. I only focused on some of few articles, but tomorrow I'll come back again. So we'll see you again. Okay. Happy good night. Now it's 11:53, so I have to go to sleep. Okay. Bye bye.